Something is happening right now in the global economy that almost no one is paying attention to. It's not in the stock market, it's not in crypto, and it's definitely not in the headlines. It's happening deep inside the plumbing of the physical world, and it's sending out a signal, a warning, that the entire system is under a kind of stress we have not seen in decades.
All right, let's break that down. This quote isn't just hyperbole. Structural dislocation. That's a fancy way of saying the old rules are completely broken. The normal cycles of supply and demand, the models that have worked for generations, they're not working anymore. We are officially in uncharted territory. And there is one single piece of data that proves it. You're going to want to remember this term, TC/RCs. I know it's obscure financial jargon, but right now it is the single most important economic indicator you've probably never heard of. Just think of it as the price to turn raw copper ore into pure, usable metal. When there's tons of ore to go around, miners pay the smelters a nice, high fee. But when there's a shortage of ore, that fee starts to drop. So what happens when that shortage becomes an all-out crisis? The fee goes negative. That's right, the number has cratered to minus $60 per ton. This is an economic absurdity. It means the world's smelters, these giant industrial furnaces that are the heart of the copper industry, they are so starved for raw material that they are now paying miners to take it. They're literally losing money on every single ton they process just to keep the lights on. This is a 5-alarm fire for the physical economy. It's a flashing red light, a screaming siren that signals an acute, undeniable shortage of a metal that is absolutely foundational to everything we're trying to build, from the entire green energy transition to the AI revolution itself.
So the real question is, what's actually causing this breakdown? And maybe more importantly, what happens next? That's what we're going to unpack right now.
The first piece of the puzzle is a demand shock that's unlike anything we've seen since China industrialized. But this time, it's not coming from building new cities or factories. No, it's coming from the intelligence economy.
You see, an AI data center isn't just a big building full of computers. It's really a massive power conversion plant. The server racks needed for AI training, they draw 4 to 6 times more power than traditional servers. And that forces a complete thickening of the entire power grid inside the building. We're talking heavier bus bars, beefier switchgear, bigger power supplies. All of it translates to over 40% more copper for every megawatt of capacity.
And those percentages add up fast. A single hyperscale AI data center, the kind that Microsoft, Google, and Amazon are building as we speak, can chew through up to 50,000 tons of copper. And that's before a single GPU even gets switched on.
Now, to put that number into perspective, 50,000 tons is the entire annual output of a pretty respectable mid-sized copper mine. So for every one of these massive AI facilities that gets the green light, the market somehow has to find an entire new mine's worth of supply. And here's the kicker. This demand is what we call price inelastic. The cost of delaying a billion-dollar AI project is so massive, they'll pay whatever it takes for copper. This has created a relentless new source of demand that, frankly, just didn't exist 2 years ago.
But that's only half the story. I mean, a demand shock is only a crisis if supply can't keep up. And right now in the copper market, supply is effectively broken. You can't just flip a switch and make more copper. This timeline shows the brutal reality of it. From the moment you even find a new deposit to the day you produce the first pound of metal, you're looking at 15 years. On average, 15 years of geological surveys, environmental permits, political fights, and construction. The copper supply is one of the most inelastic on planet Earth. It simply cannot react to price signals in real time.
And even if you had the time, the cost has gotten completely out of control. The capital intensity, which is just the cost to build 1 ton of new capacity, it's more than doubled. Why? Well, because all the easy copper is gone. The new mines are in tougher places, the ore grades are way lower, meaning you have to move a mountain of rock just to get the same amount of metal. And then you have factors like water scarcity in places like Chile and Peru, which forces companies to build multi-billion-dollar desalination plants.
So this is the key. BlackRock estimates that the price of copper needs to hit and stay above $12,000 a ton just to convince a company to even risk the capital on building a brand new mine. We've flirted with that price, but we haven't stayed there. And until we do, no major new supply is coming online. If this is the kind of breakdown you don't usually see in finance videos, that's by design. Subscribing just means you won't miss the next one.
So what do we have? We have explosive, inelastic demand from AI crashing head-on into crippled, inelastic supply from geology and economics. Capital has to get a lot smarter. You can't just throw money at the problem anymore.
So instead, it's making very specific, very strategic bets. We're going to look at 4 companies that really represent 4 totally different ways of navigating this new world. And just to be clear, these are case studies, not recommendations.
First up, we have Lundin Mining, ticker LUNMF. Their strategy isn't just finding one new mine. It's about unlocking an entire copper district through some really smart capital moves.
Their crown jewel is the Vicuña district, this massive cluster of deposits right on the Chile-Argentina border. Developing it alone would cost billions, a huge risk. So what did Lundin do? They partnered with BHP, the biggest miner on the planet. This is a brilliant capital-light move. They basically de-risked the whole project financially, letting a giant foot the upfront bill, all while keeping control over one of the most important new sources of copper for the next decade.
So if you look at Lundin stock, you'll see this really high PE ratio, and it might scare you off. But that's because the market isn't pricing its boring current earnings. It's pricing the enormous future value of that Vicuña district. This isn't really a value stock. It's a growth stock disguised as a mining company. The entire bet is on their ability to pull off this long-term vision. Next, let's look at a completely different risk profile. First Quantum, ticker FQVLF. This is not a growth story. This is a high-stakes bet on a political comeback. You can almost think of it as a call option on a single event.
Here's the situation. Their flagship mine, Cobre Panama, got shut down because of political chaos. Now it's just sitting there, costing the company over $200 million a year. The market has priced this company as if it's going bankrupt. But if the new Panamanian government can figure out a deal to restart that mine, the stock could easily jump 50 to 100%, maybe more, almost overnight. And they've got an ace in the hole, the Taca project over in Argentina, which a new pro-investment government could finally unlock.
The stock is trading at a massive discount, way below the $10 billion plus it would cost to just replace its physical assets. So the value here has nothing to do with the price of copper. It's tied to a political decision in Panama City. It's what we call an asymmetric bet on a single outcome. A true distress play where the downside is pretty clear, but the upside could be absolutely explosive.
Okay, our third case study is Hudbay Minerals, ticker HBM. This is a strategic, geopolitical play. It's really a bet on the reshoring of critical supply chains right back here to the United States.
Hudbay's key asset is its copper project in Arizona. Now, the crucial detail here is that it's fully permitted and it's on private land. This is a huge, huge advantage. It lets them sidestep years of federal red tape that has killed so many other U.S. mining projects. And to top it off, they've secured a $600 million investment from Mitsubishi, which basically validates the project and solves their funding problem in one shot. Here's the crazy part. Despite holding one of the only shovel-ready, large-scale copper projects in the entire United States, Hudbay is trading at a significant discount to its peers. The market, for right now, is just pricing it like any other miner, completely ignoring the massive strategic premium that Made in America copper is going to command in an increasingly unstable world.
And finally, we have Southern Copper, ticker SCCO. Look, if First Quantum is a high-risk option, Southern Copper is the long-duration bond of the copper world. This is a play on stability and just massive in-ground resources.
Southern Copper has the largest copper reserves of any publicly traded company on Earth. We're talking over 50 years of mine life. But its real advantage, its secret weapon in today's market, is that it owns its own smelter. Remember those negative TC/RC fees that are crushing everybody else? Southern Copper is completely immune. It processes its own ore, which means it captures the full margin and turns a market-wide crisis into a massive competitive advantage.
So yes, you'll see it trades at a very high PE ratio. But investors aren't paying for explosive growth. They are paying a premium for rock-solid stability, a reliable dividend, and an asset that will be producing copper long after many other mines have turned to dust. The risk here isn't operational. The risk is paying too high a price for that kind of certainty. Okay, so we've seen the warning signal, we've analyzed the causes, and we've looked at the strategic responses. Now we can finally answer the question we started with.
Why are smelters paying miners for rock? Why is there such a massive disconnect between the physical reality of a shortage and the behavior we're seeing in financial markets?
The answer is that the financial models that worked for the last 20 years are breaking against the hard limits of geology and physics. Those models always treated copper like any other financial asset. They assumed supply could always respond and that demand was cyclical. It's not. You can't print more copper. The new playbook isn't about forecasting GDP anymore. It's about identifying and owning the physical bottlenecks in the system. Value is no longer flowing to the smartest algorithm.
It's flowing to the owners of irreplaceable hard assets.
This story is still unfolding. So, to stay ahead, here are the 5 signals you should be watching that will tell you where we're headed next. The adoption of bio-leaching tech could unlock supply from old waste piles. Argentina's RIGI approval is the green light for some massive projects. Transformer lead times, that'll show you if the grid itself is the next bottleneck. Any production cuts from Chinese smelters will dictate the short-term price. And Panama's credit rating will tell you exactly how desperate they are to get that Cobre Panama mine restarted.
Most people just watch the ticker price. They react to the headlines. But the real story, the real edge, comes from understanding the structural shifts happening just beneath the surface. This channel exists to explain why the markets are moving, long before it becomes obvious. If you want to stay ahead of that curve, this is where that work continues.